Hello, everyone, and welcome to Finability's virtual workshop. Today, we're talking about income and taxes. This is part of a five-part workshop series we designed in partnership with Financial Beginnings, focused on reclaiming your finances and thriving. I'm Jolene, the Director of Programs at Finability, and I'm here with Stan, the instructor of our workshop today. Stan is a longtime volunteer of Finability, and I'll also let him introduce himself.
Thanks, Jolene. Yes, I'm a retired executive out of the business community technology sector. And in addition to being a longtime volunteer with Financial Beginnings, I'm also on their board of directors.
Finability is a 501c3 nonprofit with a mission to create financial pathways to safety and joy because we believe that every survivor of domestic abuse deserves the opportunity to thrive. We work to provide the financial tools, mentorship, and support to make that possible. We are an organization by survivors for survivors, and we were founded in response to the reality that 99% of survivors experience financial abuse. Because of that, we know that the information we're sharing today might land differently for each of you. Some folks might feel affirmed or empowered, others might feel overwhelmed or activated, or reminded of painful experiences. And all those reactions are valid. So, this is just a reminder to please take care of yourself in whatever way you need throughout this workshop. So, when we talk about income, we want to start by expanding what that really means. Your income is more than just wages from a job, it's any resource that supports your safety, stability, and well being. So, this can be SSI, SSDI, child support, public benefits, gig or cash work, or support from community or family. And if you don't have income right now, that's okay too. There's no judgment here. You're not behind and you're not doing anything wrong. Everyone's starting point is different, especially after suffering financial abuse. Earning money in any form can be part of rebuilding confidence after experiences where control was taken away. And it's important to remember that you have the right to decide where your money goes and who has access to it. And one note of empowerment: every dollar you earn, receive, or direct to yourself strengthens your independence. And with that, I'm going to hand it over to Stan.
Thanks, Jolene. When we talk about income, there's three general categories of income that you could be receiving. The most common is earned income. This could be money from a job, and other income that may come from other sources would also fall under this category. Then there's unearned or passive income, and that's generally income that comes from your investments, rental property, things of that nature. And then you have portfolio income, which would also come from investments. The point here is that you've got multiple categories of income, and you want to look at each category as you move forward. Now, when you're looking at your income, or when you're looking at, particularly if you want to change your profession, your job, your earned income piece, you may want to consider what state you lived in and what occupation you're looking at considering. This is a URL at the Bureau of Labor Statistics that has this map. It's an interactive map. You click on each state, and then you'll have the option to click on an occupation. And when you do, it will tell you, as you see up in this example, the bottom 10% hourly and annually up to the top 90 percentile. This happens to be for a social worker in the state of Oregon, and a little bit dated, but it gives you a range so that you can say, particularly if I'm going to go back to school to increase my earning power to be a social worker, then I can see where I may fall as I get out of school. I may be on the lower half. And then as I work in that profession longer, I can increase my earnings up to the larger half. So just a way to get an idea on what a particular profession would pay. Now, this is important to know because, one, you want to make sure your salary meets your expectations, but it'll also help you determine your return on investment if you're going back to school. So if you're going to spend money on going back to school, make sure that it pays. You're going into a profession that's going to make the kind of money you think that profession would make. Now, these are statistics that are reported back to the Bureau of Labor and Statistics. So it's a range, it's a guideline, but it is something that you can take a look at, do some research on before making a career change or a career pivot.
And before we jump into talking about taxes, we just want to acknowledge that this process of talking about taxes and dealing with taxes can feel really overwhelming, especially if someone else has handled your finances in the past or used taxes as a form of control. So, filing taxes is one way to reclaim your financial story. And paying taxes can also be a sign of your growing economic independence, especially if income or financial decisions were previously monitored or controlled or restricted. So, even if you don't owe taxes or don't have taxable income right now, this is still an opportunity to check in with yourself and understand your whole picture and understand your whole situation is more than just paperwork, but can help you plan ahead and think about goals like housing, savings, or education. And a final note of empowerment before I hand it over to Stan is that feeling informed about your taxes is not just, it's not about perfection. It's about, reclaiming that control and taking back your financial voice.
Great. Thanks, Jolene. Now, one word of caution or introduction to this topic. We're not tax professionals. We're not here giving you specific tax advice. We're here to talk about the concepts behind our tax system. And so if you have very specific questions about your situation, you should seek out a tax professional to answer those questions. Now, when you look at taxes, there are four different categories of taxes that we pay. The first is income tax. This is the tax we pay on the wages we earn. The second is sales tax. This is taxes that are charged when you purchase things. And this varies by state. You have an excise tax. Excise tax are charged on things like gas, cigarettes, and travel. If you've ever noticed, if you've gotten an airplane ticket with miles, you still end up paying a little bit of tax. It's not a completely free ticket, and that's the excise tax being charged. And then there are taxes on assets. When you sell an asset like a home or like stocks, if you've made a gain on that, you're going to pay taxes on some portion of that gain. So just keep in mind that it's a variety of ways that government collect the money to provide the services that they provide. And it is going to vary by organization. Now, the one organization that we're all familiar with, the Federal Income Tax Organization, is the IRS, the Internal Revenue Service. They set federal income tax policy and collect federal income taxes. We recommend that you go to www.irs.gov and create your own account there. That's going to allow you to track your taxes, to track refunds or payments. It even allows you to make payments online, which, if you've seen the fraud protection module, you know that mailing things can be a chance of of identity theft. And so I, for one, pay all of my tax that I can pay online. I pay online. Now, when you start to look at the federal income tax, uh, we have brackets in the US. We have brackets that say for different categories of filers, a person who files their income tax as a filer. We have single filers, we have married individuals filing jointly, or we have head of household. And a head of household is a filer with children, with dependents. And then whether their spouse files tax, has income or not, will determine whether they're married individuals filing joint or a head of household filing for the household. Now, in each of these categories, we've got ranges or brackets of income. So in the 10% tax bracket, they're for single filers filing from $0 to $11,600. Married individuals filing joint, 0 to 23,000. And same for head of households. And then as you make more, then the tax bracket goes up. So if I'm making $47,000 as a single filer, the first 11,600 is taxed at 10%, and the next amount from 11,006 to 47,000 is taxed at 12%. What this means is that we have something called we call it the marginal tax system. So if I'm in the 12% tax bracket, that means any additional dollar I earn is going to be taxed at 12%. But it doesn't mean that I paid 12% on all of my income. Okay. So in this case, um, Gabby is a single earner, gross income of 60,000. So we'll come back and talk about deductions. Well, I'll talk about it now. So you get to deduct a standard amount from your income. That's what the government has said. Everybody gets to deduct a standard deduction. It varies again by the category that you're filing. So Gabby took the standard deduction of 13,850, and she ended up with taxable income of 46,150. So on the first 11,000, she's taxed at 10%. In this next category, she's taxed at 12. And then from 44 to 46, she's taxed at 22%. All right. So that means if I add up all of these taxes and divide it by her income, she's actually paid 9.1% of her total income in taxes. And it's less than 10% because of that deduction. So when somebody says they're in a tax bracket, that's the amount they're paying on the next amount of taxes. We'll let my slides jump here in just a minute. Now, in addition to federal taxes, we're going to pay state taxes. And every state has a different amount that they charge. So if I look at Oregon state tax, the maximum amount is 9.9%. Nevada doesn't charge any state income tax. Alaska, Tennessee, Texas, these are all states that don't charge a state income tax. So they're getting their tax revenue from other places, one of those other sources that we talked about. It could be from hospitality tax on hotel rooms or excise tax or sales tax. So from a state standpoint, this is the state income tax by states. And if you go to this presentation, we'll get you the link that you can see what your state happens to charge. All right, let's talk about filing taxes. So in order to file taxes, the first thing you'll do when you start to work for someone is you'll complete a W-4. Then at the end of the year, you're going to get a W-2. These are form names. And then you're going to use a Form 1040 to file your taxes. The W-4 is a form that allows you to tell your employer how much they should deduct from your paycheck. So you're going to go through and identify the number of dependents that you have and can have other amounts taken out so that you can adjust the amount that's taken out of your paycheck each week. Everybody fills out a W-4 when you start working for someone, and you can oftentimes, with most employers, adjust that throughout the year. Now, if you're a self-employed person, then you're going to fill out a W-9. A W-9, again, is a contractor or a freelancer, and it just identifies your organization with either your tax identification number or your Social Security number. And then you will give that 1099 to a company that you contract with. At the end of the year, you're going to receive a W-2, and this is going to outline all of the income that you've earned and federal taxes and state taxes that, if any, that have been withheld. Okay, so this is the document you're going to use when you begin to file your taxes. And if you're self-employed, then you may receive a Form 1099 from the company that you did contract work for. It takes the place of your W-2. When you're ready to file your taxes, the Form 1040 is the individual tax return form. And so that's the form that you'll use. Now, just to recap, filing our taxes, we're going to create this taxable income category. We're going to start with our gross income. We're going to subtract deductions, and that's going to return an amount that is our taxable income. And this is the income on which our tax liability is going to be calculated. Tax deductions come in a couple of different ways. First, you have a standard deduction. Everybody gets a standard deduction. This is an amount the government has said, depending on your status, that you can automatically deduct from your income before we start calculating before we get to your taxable income. Then you may have other itemized deductions. If you have itemized deductions that are greater than the standard deduction, you'll do those. If they're less than the standard deduction, you'll use the standard deduction. Okay? But this, you record these, and this will vary by individuals. But one example of itemized deductions is off a state tax that you've paid. Those can oftentimes be deducted on your federal tax. So you're going to have your taxable income. It's then going to, based on your income and the different brackets that we looked at earlier, going to multiply it by each bracket amount and rate. Total that up, and that's going to equal the amount of taxes that you owe. So we'll look at each bracket, calculate the taxes owed, and come up with a total of taxes owed. Then the government looks at taxes owed. You're able to take any tax credits you might be been able to claim. There are certain tax credits for childcare or adoption or other items. And so tax credits are a direct reduction of the taxes owed. Finally, you're going to subtract the taxes you've already paid. So where have you paid taxes? Well, every paycheck, when your employer is taking money out of your check, you're paying taxes on every paycheck. And so they're going to take the taxes owed minus the taxes paid. And if then you've paid more than you owe, you get a refund. If you've paid less than you owe, then you need to make a payment. Okay. And so then you'll get either a tax refund or a tax bill. Now, a lot of people look and say, wow, I'd like to get a tax refund. But in getting, slide jumped ahead, in getting a tax refund, you may actually have paid too much taxes throughout the year. And so if you get a large tax refund, you may want to go back and adjust your W-4 so that you have less money taken out of your paycheck. And so that when you file your tax at the end of the year, you have a small refund or owe a small amount. Now, you may want to receive assistance in filing your taxes. There are a variety of places that you can receive assistance. There's software that you can download. There are online tax filing services. You can find a tax professional. The IRS has some resources. They've actually experimented a little bit with a free tax program. It's still an experimental stage. And then there are community resources that may be available. So find a resource that's available to you, particularly if you're in a lower income category, and can find a community resource that may help you at a low or no cost basis. Best practices, we recommend this at the end of end of each module. Start an emergency fund. An emergency fund is a savings account that you set aside for emergencies because emergencies happen. And you want to take care of those emergencies without putting that on a credit card. Best example I can think of is you have a car accident. You have a $500 deductible. So you want to have an emergency fund to be able to make that deductible. Or you need a new set of tires on your car. And maybe you've got $1,000 in your emergency fund. Then you can use that to buy the tires, and you don't have to it's a non-regular expense. You're going to do it once very randomly. but you want to not have to put that on your credit card if you don't have to. Um, Start with a emergency fund of $500, grow that to $1,000, and then go and reduce your debt or eliminate your debt, everything except your mortgage. By eliminating your debt, you're freeing up money in your budget, and you're going to free up an emotional burden if you can put this debt aside. Go to our credit and debt module, and you'll see strategies for eliminating your debt. Lastly, enroll in your 401k. If you have a 401k at work, put 2 to 3% of your income into that 401k, and your take-home pay will be about the same. So when you're calculating the taxes owed, the contribution to your 401k reduces your taxable income. And so at 2 to 3% is about that balance point where most people end up with the same take-home pay as if they did deduct 2 to 3%. So talk to your human resource department or your finance department, whoever administers your 401k, and start at 2 to 3% if you can.
Thank you so much, Stan. I was taking notes. I always learn stuff, especially around the tax stuff. So thank you. Sometimes this information can feel really overwhelming. We want to encourage you to celebrate the small milestones along the way. And this can look different for everyone, but some ways to acknowledge what you've already done might include recognizing the courage that it takes to make a financial decision, especially after experiences where control has been taken away. And honoring the steps that you can't see. So things like setting boundaries, asking questions, maybe reaching out to a new resource, learning something new, or saying no to something that drains you. And then celebrating consistency over perfection. So showing up for yourself matters way more than getting everything right all the time. And then acknowledging the emotional wins. So feeling confident, more calm, or more clear about what you want or you need. And then giving yourself credit for rebuilding at your own pace. Healing and financial independence both happen step by step. Finally, thank you so much for joining us. If you want to learn more about what we do at Finability, the other programs that we have, please visit our website, finability.org. We also have a contact us button on our website, and we'd love to hear from you. So if you have feedback, thoughts, questions, or anything else that you'd like to share with us, please reach out anytime. And thank you so much, Stan. Really appreciate learning from you. And thank you to Financial Beginnings for being such a wonderful partner in offering these workshops. And I hope everyone has a great rest of their day. Take care.